Hi everyone, we are from Group 1. In today's presentation, we'll be talking about accounting, which is chapter 17 of our book. The learning objectives for this chapter are the role of accountants, the accounting cycle and bookkeeping, financial statement differences, ratio analysis, and different accounting disciplines. First things first, it is important for us to understand what accounting is. Accounting is the process of recording, classifying, summarizing, and interpreting financial transactions to give a business the information they need. Next up is the accounting system. The accounting system allows a business or a company to keep track and summarize its financial transactions. There are 3 steps in an accounting system. The first one is inputs. As you can see from the slide, the inputs are the accounting documents, including sales documents, purchasing, shipping, and other documents. The process is where the data are recorded, classified, and summarized. The records are then turned into financial statements, including balance sheets, income statement, statement of cash flows, and other reports in the final process, known as outputs. Another essential term to know about accounting is the word stakeholder. A stakeholder is an individual or a group of people who own a share in a business. Examples of stakeholders include employees, owners, creditors, unions, investors, and the government.
What is the accounting cycle, and how many steps do I have to remember? Well, what do accountants do? They do bookkeeping, the recording of all financial transactions into an online or physical journal, raw data filled with dates, time, names, and memos. Categorizing, transferring the journal data into the ledger, which is usually sorted into 5 categories: assets, liabilities, owner's capital, revenues, and expenses. Trial balancing, looking for any errors in the ledger by matching debits and credits. Report entries, the final interpretations of the financial data, balancing sheets, statement of cash flow, income statements, and ratio analysis. Onto the accounting cycle. Steps 1 and 2 are part of bookkeeping. Step 3 is categorizing. Steps 4 through 6 is trial balancing. Steps 7 through 8 are the report entries. The digital revolution and its consequences to accounting. Or, how have computers affected accounting? Efficiency. Calculations are made in an instant. No more are the days of meticulous counting one by one or remembering formulas. The internet has it all. Location. No longer bounded to a physical and ephemeral journal. Make entries into the journal all around the globe. Universal tools. Startups and e-businesses have a new weapon to compete against large and established companies.
The 3 major financial statements. So for the 3 major financial statements, there is the balance sheet, income statement, and statement of cash flows. Let's begin with the balance sheet and talk about what that looks like. So the balance sheet contains all assets, liabilities, and equities. The assets, liability, and equity make up the accounting formula. The main purpose of the balance sheet is to make sure that all the assets equal all of the liabilities and the equity. If the balance sheet comes out where the assets don't equal the liabilities and the equity, that means there was a miscalculation or something went wrong with the inputs and the outputs. The accounting equation is what makes up the balance sheet. So when people talk about the accounting equation, when people talk about assets, liabilities, equities, that is referring to the accounting equation, and that is what's used on the balance sheet. Next is income statements. Income statements cover revenue, costs, expenses, and taxes. This is where the revenue is subtracted by anything expensed or spent from the company. So costs such as manufacturing costs, facility costs, shipping costs will be taken from the revenue, and then you would figure out the total profit from the revenue, whether you would have a net income or a net loss from that revenue. So for the statement of cash flows, this covers where all of the money or all of the cash is being distributed. So the statement of cash flows covers wherever the money is going and coming out from. The statement of cash flows makes sure that money is being spent where it's supposed to be spent.
Ratio analysis. Demonstrate the application of ratio analysis in reporting financial information. Ratio analysis is a tool for accountants to monitor a business's financial performance and health through key ratios, such as liquidity ratios, leverage or debt ratios, profitability or performance ratios, and activity ratios. Liquidity ratios pertain to short-term cash availability requirements, ensuring that a business is able to pay the bills, so to speak. These include current and acid test ratios. A good current ratio is 2-to-1 for liquid assets to liabilities. Think of quote by billionaire entrepreneur Jay-Z, "If you can't buy it twice, you can't afford it." The same concept applies to businesses. Leverage or debt ratios pertain to a business's reliance on debt or borrowed funds, such as loans or investing. Often measured by debt-to-equity ratios, the information is valuable to project the likelihood of repaying debts. Alternative names include risk or gearing ratios. Debt-to-equity ratios below 1 are more stable, whereas ratios above 1 are more risky. Profitability or performance ratios pertain to expenditures, revenue, and profit. They measure the efficiency of a business's operations. EPS ratios and return on sales or equity ratios lay out spending and profits to review profitability. These ratios are arguably the most important as they are useful for all business models. Activity ratios pertain to a business's effectiveness as a whole. For example, the speed at which inventory is sold. Inventory turnover ratios measure the cost of goods sold to the average inventory within a period. Activity ratios should only be compared to similar business models within an industry, as they can vary greatly from field to field. Activity ratios measure sales purely. Quantity is the goal for activity ratios.
Accounting disciplines. Private accountant. Private accountants that specialize in the laws, rules, and regulations of the preparations and calculations of federal, state, and local taxes. A public accountant, a gig economy accountant, provides accounting work to clients for a set rate. Certified public accountant, or a CPA. They're pretty much a public accountant, but they've been certified by the American Institute of Certified Public Accountants. Their license is earned with a mixture of education, experience, and examination. Tax accountant, a specialized accountant whose focus is managing an entity's tax finances. Government and not-for-profit accounting, accounting with a stronger focus on maximizing budget instead of profiting. Auditing, the verification of the totality of a business's financial data. Managerial accounting, the combination of accounting tools and ratios used to steer the direction of a company financially. Here's our bibliography. Thank you for listening to our presentation.